Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's late March 2023, and I'm going to be in this video, which may be a bit shorter than usual, updating you on the developments in the global monetary scene. I want today to focus only on the three Western economies that are of particular interest to us. That's going to be the United States, the Eurozone and the UK. I'll say one or two things about China, India, Japan. The message can be short and sweet, although perhaps not so sweet as it might be, because in fact the news is rather worrying. You will remember that back in early 2020, I pointed out the explosion in money growth that was then occurring in these economies, in the United States, the Eurozone and the UK, a bit elsewhere, but particularly really in those three economies. And I warned about a coming inflationary boom and rising inflation as economies return to normal after the COVID pandemic. Today, the situation is radically different. We have had the inflation, that's been correctly forecast. Now we have a collapse in money growth, and in the last few months, the quantity of money has actually been falling in all three of those places, all three, that's the United States, Eurozone and the UK. And even in the United States now, the change in money in the last year is a fall. It's not just a fall of a few months, it's a fall in the whole year. And so what I want to do is to just summarize those developments, look at those three places a bit more specifically, and then to say a few things about where we're going from here. So first of all, let's look at the United States. This is a chart that goes back to the Great Recession. You can see that, was it back in, that doesn't take us all the way back there, but as it does, just takes us back to 2009, 2010. Quantity of money contracting wasn't actually a very good leading indicator at that time, but it was, anyway, we did have contractions in money in the US Great Recession, in a period of stability. And then we get this explosion, 2020. On the 12-month measure, that's the brown line, the high money growth rolls through into 2021. It comes down, and then the last few months, money actually contracting, and the brown line has finally gone negative in the opening months of 2023. This chart finishes in January. We do have numbers for bank deposits in February and 2 weeks in March. There's the quantity of money, which includes bank deposits and notes and coin. We get more detailed data on deposits on a weekly basis. And what these figures show is that the quantity of money kept on falling, deposits dominate money, kept on falling in February and those first 2 weeks in March. So this is a continuing trend. Roughly speaking, money is going down at around about 0.5% a month, 0.25% a month, those kind of numbers. In the US Great Depression, not the recession, the US Great Depression of the early 1930s, money was falling by about 1% a month. Yeah, things aren't that disastrous at the moment because there's still this cushion, this overhang from 2020 and 2021. But the way things are going, one really has got to flag up a recession, and potentially quite a bad one. These numbers are, of course, very different from what I was talking about 3 years ago. Boom-bust cycle. Total incompetence on the part of the Federal Reserve, but inflation coming down, and probably in 2024, coming down towards the 2% figure, which is the kind of target that central banks have in mind these days. Now, the Eurozone, for much of last year, was very different. In fact, rather high money growth carried on really until autumn of last year. Then in the very final months of last year, collapsed. Quite why this happened, the suddenness, I'm not sure, but at any rate, that's what the data show. The 12-month change is still positive. The blue line is still, I think, probably about 3% or so, very much down from the figures over 10% we had in 2021. And the way things are going, this will probably go negative in the next 3 to 6 months. Just a little bit by way of reflection on this chart. You can see it goes back, in fact, all the way to 2005. Rapid growth of money, 2006-07. There was a boom in the Eurozone then, particularly in the so-called Club Med countries, Spain, Portugal, Italy, and so on. Then this plunge, and then this rather long period of rather weak money growth, down at about 1 or 2% a year, when in fact the Eurozone, unlike the USA or the UK, had a second recession. Not a bad one, but it had a second recession. Then the 5% a year in the late 2010s, stable growth, low inflation. Rapid growth of money in the COVID period, now a collapse. So you can see the connection between what's happening to money, what's happening to the economy, this again is telling us that a recession is in prospect in the Eurozone. Some economists, in fact, have had negative quarters or even negative 2 quarters, but not as yet for the entire Eurozone. And then finally for the UK, again, money growth fairly resilient through much of last year and then falling away rather drastically towards the end. The annual rate of change still positive, the 3-month annualized number actually going down to -10 at one point here. A recession coming up. All I would say about, this is all relatively simple, relatively obvious, a warning. What happened in 2007 to 2008 was that the banks got the blame. And in autumn 2008, the powers that be, the G20 governments, their finance ministers, the central banks, the Bank for International Settlements, the International Monetary Fund, decided that the banks must have more capital relative to their risk assets. A big rise of around about 60-70% in banks' capital requirements per unit of risk assets, per unit of loans to the private sector. As far as whether you think that's desirable or not is the discussion, the effect on the economies was catastrophic because the banks started to pull in loans, to sell securities, to reduce their risk assets because they were required to hold much more capital relative to those assets. And the result of that was to aggravate, to intensify the falls in the quantity of money, the falls in bank deposits. To avert another Great Depression, which was coming up, the central banks then organized these quantitative easing programs where the central banks bought assets from non-banks, which increased the deposits held by non-banks, and that did deal with the problem. However, the talk is now, with the failure of SVB Bank, the troubles, Credit Suisse, the absorption of Credit Suisse into UBS and so on, talk is of another round of increases in capital asset ratios for the banks. It's not just the banks that are delinquent, but the regulators. Because what that will do is to make any coming recession even worse. That's my message this time. I'm sorry it's a little bit gloomy. One has to be direct about these things. I have been very busy the last few weeks writing a pamphlet for a think tank called Politeia. I'm giving a presentation in London on the 26th of April about that. It's about what's happened in the COVID period to monetary policy in Britain. So I hope you can join me for that. I'm afraid I haven't had time to deal with the non-monetary theories of inflation that have been going around, and which are frankly wrong. But I tried in this short video to talk about the move to contractions in the quantity of money and the risks that these will get worse if the regulators blunder as they did in 2008. Thank you.